In this video, I will be discussing how to determine an exit price under fair value accounting. In a previous video, I mentioned that up until this point, you've just been given the fair value. Even in our fair value lectures so far, I've just given you the exit price, which is the foundation of the fair value measurement. Now it's finally time to figure out where that exit price comes from. The first step is to determine if the asset is financial or non-financial in nature. Financial assets have their value based in a contractual claim, such as the debt and equity securities we just got done studying. Financial assets are usually easier to value because there are clearly observable markets where these instruments are traded, or their cash flows can be easily predicted and discounted. Non-financial assets have their value based on a physical item. Yes, like a horse. These assets are more difficult to value because no two items are identical. There may be multiple ways in which these assets are used. Yes, like how you might use a thoroughbred horse for any of those things. And the markets for non-financial assets are often less easily observable. When we have a non-financial asset, we first need to determine the highest and best use of that asset. For example, you could use a car as a mode of transportation, or you could use it as a flower pot. I think it's safe to assume, however, that most market participants would believe a car to be more valuable as a mode of transportation. Sure, lots of people have horses in their backyard as pets. Right, but that's unlikely to be the highest and best use of a horse to the market. Let's look at an example. In this example, we have JEP Enterprises acquiring land in a business combination. Now this is important to note because we're going to have some examples here where we're recognizing things at fair value that we normally wouldn't. Like in this one, we have property, plant, and equipment, which would typically be historical cost. But anytime we have a business combination, any assets or liabilities acquired in that combination are going to be marked up to fair value. And so that opens up a situation where we're going to use fair value accounting for all sorts of assets and liabilities that normally we wouldn't. This will be important when we get to business combinations a little bit later in this course as well. So here we have land that's currently being developed for industrial use as a site for a manufacturing facility. Nearby sites were recently developed for residential high-rise condominiums. Based on recent zoning and other changes that will facilitate development for residential high-rise condominiums, JEP determines that the acquired land currently used as a site for manufacturing facility could also be developed for residential use. The fair value of the land in the manufacturing operation, which presumes that the land would continue to be used as currently developed for industrial use, is determined to be $8 million. The fair value of the land as a vacant site for residential use, considering the demolition and other costs necessary to convert the land to a vacant site, is determined to be $11 million. So what would be the fair value of the land? Okay, so its current use is as an industrial site. And at that use, we believe it's going to be worth $8 million. And that's what we're planning to use it for. But we could, in theory, also demo the building, and after we did that, all our costs and everything, we could use it for condos, and that would cost, or then the land would be worth $11 million less all those expenses to get it that way. So the question is, which one do we use for our fair value? Again, it's tempting to use the $8 million because that's our intent. That's what we're planning to use the land for. But that doesn't actually matter in fair value accounting. What matters is the highest and best use. So in this case, the highest and best use is for condos. It would be worth more if we used it for that. And so our highest and best use is condos. So that means that the fair value that we're going to use is the value of the land as condos, which would be $11 million. Once we've identified the highest and best use for a non-financial asset, we need to next identify the principal market. First, we will identify markets in which the company who owns the asset or liability normally transacts. From that list, the principal market is the one that has the greatest volume of transactions flowing through it. Because not every company has access to the same markets, it is possible that different entities will identify different principal markets. If for some reason we can't identify a principal market, then we will use the most advantageous market. The most advantageous market is the one that would maximize the amount received in our fictitious sale into the market. Yeah, this is a tough one for the horse project, Chloe. I mean, people do sell horses on Craigslist, but is it the principal market? It's definitely not the most advantageous market. Given that the horse market isn't particularly observable, we probably won't be able to identify a principal market. Typically, the most advantageous market is the dealer market, in which professional horse trainer markets and brokers the horse's sale. Let's take a look at an example. In this example, we have a car company that has 100 used cars that are all the same make, model, and mileage that it needs to measure at fair value. Assume the car company has access to 3 markets for leased cars or similar assets: the dealer market, the rental market, and retail market, and the spare parts market. Management's intent is to sell into the dealer market. So we have this table here that tells us information about the 3 markets that our company has access to. It has the price per car in each of those markets. It has the entity-specific volume, which means the volume of transactions that car company actually does. So they usually use the dealer market 60% of the time. And then there's the total market volume. So that's all the market participants, not just car company. So if we look at the total market, we find that most of the transactions go through the retail market. So our first question here is, which market is the principal market? So our steps here to figure out the principal market is we first have to identify all of the markets which our company has access to. And we've done that in this table. So dealer, retail, spare parts. Then once we have those, we need to find the one with the highest volume of transactions. Now, if we look at entity-specific volume, that gives us a different answer than total market volume. Here, we need to look at total market volume because we want to know which one has the most transactions flying through it the most often, because that's going to give us the most reliable value. So here, because the retail market has 75% of the total market volume, that's going to be our principal market. For part B, it asks us which market is the most advantageous market. So the most advantageous market is going to be the one that gives car company the most bang for its buck. So if we sell our cars into the dealer market, that's going to give us the highest price, or $30,000. So that's going to be the most advantageous market. So now, in part C, it says, which market should car company use to measure fair value? Now, here's where it gets a little bit confusing, because their intent is to sell it into the dealer market, and the dealer market is going to give them the best value. So it's tempting to use that one as our fair value measurement. However, our fair value rules say that if you can identify the principal market, you need to use that. And our principal market was that retail market. So we're going to use the retail market and value each of these cars at $25,000 for fair value accounting purposes. Once we identify the principal market, we must consider the reliability of the values we observe there. When the market is active, transactions will take place frequently enough that at any given point in time, we can observe a reasonably accurate valuation. When there are very few transactions taking place in a market, then the prices we observe may be stale or less accurate than if there were more participants and transactions to consider. We also need to consider whether transactions we observe in the market are orderly. Transactions that follow typical marketing practices for that asset or liability are more accurate than those that do not. One of my neighbors fell on hard times and sold her house to another neighbor for an all-cash transaction. The house was never listed on MLS, as is customary for home sales. It was marketed only to that one neighbor who made the purchase, and the seller was near bankruptcy. Because this transaction was not orderly, we cannot be certain that the price paid for the house is indicative of its true value. This concludes part 1 of our lecture on determining exit price. Don't forget to email any questions for our discussion.